Welcome to the deep dive. Okay, let's jump right in. AppLovin's Q3 2025 update. This digital marketing firm really crushed it.
Yeah, they didn't just beat expectations, they delivered big time, and the outlook looks incredibly strong too.
Right, a very decisive win. So our mission today, get past the headlines, find the key numbers, but really understand why. What drove this, massive performance jump?
Exactly. What's the tech? What are the structural drivers behind these numbers? That's what we need to figure out for you.
Okay, let's unpack Q3 then. Top line first. Revenue came in at $1.41 billion.
Which is, just huge growth. Was that 68% year over year compared to about $835 million last year?
Yes, 68%. And critically, it sailed past the Wall Street consensus, which was expecting something like $1.34 billion.
That beat is the headline, sure. But for you, the listener, the really interesting part is how they got there. It reveals a lot about their model.
Okay.
Well, here's the paradox, right? Revenue's up 68%, like you said. But installations think new users. Downloads, they actually decreased slightly, down 1% year over year.
Wait, hang on. Down 1% on installs, but up 68% on revenue. That doesn't immediately compute. How does that work?
It signals basically superior monetization efficiency. They're getting much, much better at making money from the users they do have.
Okay, so efficiency is the key. Is there a metric for that?
There is. It's called net revenue per installation, or RPI. And get this, it surged an incredible 75%. 75%.
Wow, so they're making 75% more money from roughly the same pool of users as last year?
Exactly. They're not just chasing volume anymore. They're optimizing the yield from each installation.
That's a huge shift, and I assume this has everything to do with their software platform, their tech.
Precisely. This is where their software platform segment comes in, and specifically their machine learning engine, AXON. The sources point directly to AXON as the driver.
Right, so that's their predictive tech.
Yeah, it's basically a super sophisticated model. It analyzes potential users in real time, predicts their likely lifetime value LTV with apparently really high accuracy.
So it helps them decide who to bid on for ads. Like, this user's worth bidding high for, that one isn't.
You got it. They can figure out, maybe this click costs $1, but it'll likely generate $3 down the line. Another click might cost 50 cents, but only generate 50 cents.
So they can confidently outbid competitors for the valuable users and just ignore the rest.
Exactly. That hyper-targeted bidding based on predicted value is what fuels that massive 75% jump in net revenue per installation. They're maximizing the value of every ad dollar.
And that focus, optimizing value, not just volume, clearly dropped to the bottom line too. Earnings per share, $2.45?
Yep, $2.45 diluted EPS, which beat the $2.37 or less we're looking for, so about an 8-cent beat there.
It shows that efficiency isn't just some vanity metric, it's genuinely driving profit.
Absolutely. And that link from the top line story to the bottom line profitability, that's maybe the most impressive part structurally.
Let's talk margins then, because that really shows the operating structure, doesn't it? Adjusted EBITDA, up 79% year over year, hit $1.16 billion.
Huge jump in EBITDA dollars. But yeah, the margin percentage is where you see the leverage.
It expanded to 82% in Q3. 82%. That's up from 77% last year.
5 full percentage points of margin expansion while revenue grew 68%. That's significant operating leverage kicking in. You're seeing the power of the software platform.
Okay, but let me push back slightly. An 82% adjusted EBITDA margin in ad tech, that feels extraordinarily high. Is it sustainable? Are they maybe, underinvesting somewhere to hit that number?
That's a fair question. The sources suggest it's linked to the nature of the platform itself. Once AXON, the core software, is built and running, the incremental cost of handling more revenue seems to be pretty low.
So it's mostly fixed costs already sunk and the variable costs are minimal.
It seems that way. The net income growth up 93% to $836 million is explicitly tied in the reports to increased operating efficiency and reduced expenses, particularly in R&D and marketing.
So they don't need to keep pouring money into R&D at the same rate as revenue growth because the core engine is already performing so well.
That seems to be the implication. It reinforces that high-margin, software-centric structure. Plus, there are hints they're getting traction outside of just gaming now, like in e-commerce ads.
Diversification helps too, broadens the base for that efficient engine.
Right. It's not just mobile games anymore.
And all this profit and efficiency translates into cash, right? The cash flow numbers looked pretty strong.
Very strong. Net cash from operations and free cash flow were almost identical, both around $1.05 billion.
Which tells you what? Why is that significant?
Well, when operating cash and free cash flow are that close, it means they have very low capital expenditure needs. It doesn't cost them much to maintain or grow the business physically.
Asset light.
Exactly. Reinforces that software model. The profit converts almost directly into cash they can actually use.
Okay, so if they're generating that kind of cash and the core engine is humming, management must feel pretty good about the future. Let's look at the Q4 guidance. Always important with the holiday season.
And they delivered there too. The guidance top consensus estimates again. For Q4 revenue, they're guiding $1.57 billion to $1.62 billion.
Which is above the $1.55 billion Wall Street was thinking. So continued strong growth expected.
Yep. And look at the implied margins in the EBITDA guidance.
Right. Q4 adjusted EBITDA guidance, $1.29 billion to $1.32 billion. If you run the math, that implies margins are staying up there, maybe even ticking up slightly, like 82% to 83%.
Exactly. They're telling the market, look, this efficiency, this margin structure, it's not a one-off. This is the new normal for us. They clearly believe AXON gives them a sustainable advantage.
That confidence plus all that cash, it leads directly to capital allocation, doesn't it? What did they do with share buybacks?
They were active in Q3, repurchased about 1.3 million shares, spent around $571 million doing it. Significant, but not the main story.
What was the main story then?
The future authorization. The board approved adding another $3.2 billion to the share repurchase program.
$3.2 billion on top of what was left.
Yeah, brings the total remaining authorization up to $3.3 billion as of the end of October. They basically tripled the remaining authorization overnight.
Wow. Okay, that's not just tweaking the program. That's a massive statement.
It really is. I mean, connecting the dots, management is signaling loud and clear. One, we expect to generate tons of cash going forward to fund this.
And two,
we think our stock is cheap right now. They believe buying back their own shares is the absolute best use of that future cash flow. Better than M&A, better than anything else right now.
it's a huge vote of confidence from management in their own valuation and their business model, a really strong signal for you, the listener, about how they see things internally.
No doubt. It signals current strength, future expected cash flow, all built on that incredibly efficient, high-margin software platform.
Okay, so let's try and wrap this up. AppLovin puts up this massive quarter. The headline is revenue growth, but the real story is this efficiency paradox, right? Revenue up 68%, margins hitting 82%, driven by that incredible 75% surge in revenue per installation.
All fueled by their AXON tech, which then leads to this very confident Q4 outlook and this just enormous share buyback authorization.
Right, so here's the thought, the question maybe for you to chew on after this deep dive. Their success seems totally tied to AXON making more money from the same users. Monetization efficiency.
Given that installs were basically flat, yeah.
So how long can that last?
Mm.
How dependent is their future growth on just getting better and better at squeezing efficiency out of the existing base versus, eventually needing to actually grow the number of installations again?
That's the core question, isn't it? What is the sustainable limit to margin expansion and RPI growth when your actual user volume isn't growing?
At some point, does efficiency hit a ceiling? We'll leave that with you to think about as you continue your own deep dive.